For the moment, let's get right to the floor show. Joining me now, Goldman Sachs Asset Management Fundamental Equity Managing Director Greg Tuorto. Greg, new tariffs off the table. So the market's moved on that. The markets are moving on data. What are you watching that says to you this is a time to go long U.S. stocks?
Thanks for having me, Liz. I think that there's a slightly new paradigm in place, where you have a reflation of a lot of the cyclical sectors in the market. And I think you saw that with the GDP number for the third quarter. The Atlanta Fed GDP estimate for the fourth quarter is over 5. I think a lot of people are raising their estimates for GDP for all of 2026 closer to 3. It was closer to 2, about a few months back. So you're starting to see a bubbling up of economic activity with inflation generally in check, and that leads you to a more broadening approach to the market and a cyclical approach, which is a lot different than what we had over the last compared to what we had over the last couple of years.
So what does an investor do when they see that turmoil over geopolitical issues overtakes certainly the oxygen? It doesn't take the substance, but it overtakes the oxygen of earnings and data like this. And what is an investor supposed to focus on?
Yeah, I think you just mentioned one of the things, earnings, which was really interesting because even during the maelstrom of yesterday, we had some pretty good earnings come out. Some parts of the banks, some other areas of the market that kind of gave you a read in the economy that showed you that, things are okay, maybe a little bit better than okay in some areas. I think that, the capital market side of things, I think the chase for deposits is also kind of calmed down a bit, which makes some of the banking returns look better. And I also think that, as you're seeing some of the broadening out, areas in tech that people have ignored, for a long time, are starting. So semiconductor capital equipment, where you have to build these fabs to support the memory spending that these AI behemoths need to run their machines.
And certainly we've got some of the chip equipment makers moving higher.
Yes.
Is that sort of what you're talking about?
That's exactly what I'm talking about. So semi-cap equipment, chip equipment is, I think you're going to, you have both the localization of producing in the United States, but also a sizable deficit in parts of the chip equipment ecosystem just because people hadn't been focusing on it. They haven't been spending money because all the attention and money have been focused on artificial intelligence.
What would you avoid? Would you avoid trade-sensitive stocks just because of the volatility? We were watching Elf, Mattel, Stanley Black & Decker yesterday. They really did well because suddenly we were not, there was a lighter tone and touch from the president about tariffs. But of course, that's a moving target.
Yeah, I think that there are parts of the consumer economy that I think that you want to be a little bit more sensitive with. Some of the high-end goods, I think we went through a luxury revival the last couple of years. That's coming back. I think, we had a guest earlier talking about Boot Barn. We like that a lot too. I think, workwear, especially with the cold weather coming. I do think that, when you look at the consumer, there is definitely a more kind of value approach to what they buy, even at goods and in restaurants as well. So I think I'd avoid luxury goods. That's an area that I think is something that's...
Go with the cowboy boots. Boot Barn is up about 7% year to date, and we've also got it up 21% over the 52 weeks.
Yes.
So there's the Yellowstone play there.
There's a Yellowstone, there's Landman. There's Landman, and I think, we had a big stretch of warm weather, which is now shifting, as we all know, and I think that helps with that Carhartt workwear, which kind of keeps everybody who's outside warm.
Look at you in the suit knowing about Carhartt. I like it. Good to have you. Thank you.